Welcome, everyone, and thank you for joining us for today's webinar. My name is Dermot Reiter. I'm a Senior Financial Advisor here at Apt Wealth Partners, and joining me today is Paul Barbara, who is a Director at Willis Partners. Paul is a highly experienced chartered accountant and business advisor who works with a range of professionals, business owners, and family groups on tax, structuring, compliance, and longer-term planning. He brings valuable insight into the technical tax detail and structuring implications of the recent budget changes and how families can respond thoughtfully and strategically. Paul, it's great to have you with us. Welcome.
Good to be with you, Dermot, and looking forward to unpacking this one.
Likewise. And just a reminder that what we cover today is not personal advice. It's general in nature and should not be taken as a recommendation. And before getting underway, if you have any questions, please feel free to use the Q&A box in your Zoom menu to submit a question at any time during the presentation. We'll also get to a few questions at the end, and a recording will be made available after today's event. So today's session is designed to move from the headlines associated with the recent budget changes to the practical decisions that really matter. So in particular, we want to explore what has changed in the tax landscape over recent months. We'll then clearly separate what is law now from what remains in consultation. From there, we'll look at how to effectively plan when it comes to the timing of asset sales, which is a really big consideration for a lot of families, before turning to what the proposed changes mean for discretionary trusts and how to go about reviewing these structures. And then we'll bring all of this together to give you really some practical, tangible strategies to consider using. And we'll also take a few questions at the end. So in terms of what's changed, the CGT reform is the major change that we'll start with, because for many clients, this is the reform with the broadest implications, particularly for long-held assets. The key change here is that from 1 July 2027, the existing 50% capital gains tax discount will be replaced by inflation indexation and a 30% minimum tax on gains. So importantly, gains that accrue up until 1 July 2027 are still dealt with under the existing rules. So there's the grandfathering there, which does include the 50% capital gains tax discount for assets that are held for 12 months or longer. So the new regime only applies to gains from 1 July onwards. Okay, so it's a really important point. Now, this doesn't mean clients should rush to sell, but it does mean that anyone with significant embedded gains in assets that have been owned for a long period of time should understand what they own, when they plan to sell, and how the new tax treatment changes the after-tax value of that decision point around holding versus selling that asset. Okay. The other major change is the role that tax plays in future property investment decisions. So negative gearing on established residential property has now been narrowed to new builds for acquisitions after budget night. And importantly, existing property holdings are grandfathered. So if you've already got a property that's got a negative gearing arrangement behind it, that's okay. But future purchases of established residential dwellings lose access to that same tax advantage. So really, this highlights the need for risk and return attributes of each property to really be assessed on its own merits, rather than relying on those ongoing tax savings, which people have enjoyed previously, in being able to offset losses against other income. I think it's really important to point out here, though, as well, is that these negative gearing reforms don't include commercial property investments, share portfolio investments, eligible new builds, and also most widely held managed funds, and also superannuation structures. They remain outside these new restrictions on negative gearing. So just be mindful of that. There's still opportunity to use that mechanism. The third major one, which we'll unpack in great detail today, is around trusts. So this is generating a lot of discussion amongst the family groups that we serve. The proposed new tax treatment of discretionary trusts, the government has proposed a 30% minimum tax on discretionary trust income, so the distributions from trusts. And this is intended to apply from 1 July 2028. However, this measure is still in consultation and is not yet law. So the appropriate response at this stage, from our perspective, is to test the existing distribution strategy that you might have in place and identify where the current trust structure may become less effective if these proposals proceed. And the greatest impact is likely to be felt where trusts have traditionally distributed income to beneficiaries on lower marginal tax rates, so lower than 30% tax rates, including adult children that are perhaps still getting on their feet and not earning a lot of income, and non-working spouses or corporate beneficiaries. So these are bucket companies that you can distribute to from trusts from time to time to cap the tax rate at 30%. And they're the greatest impact here in terms of these changes. So just to summarize that, before we move into the planning implications, we want to draw a clear line between the rules that are now settled and the measures that are still being developed. So just to remind you, the CGT reforms and the negative gearing changes, they are actually now law. So we can start to plan with knowledge of that. However, the trust tax proposals, they're different. So whilst they're intended to apply from 1 July 2028, they do remain in consultation and they're not yet law. So from our perspective, we think that the proposals should inform questions that we're currently asking with our accountants and other advisors surrounding the clients. And they're giving us an opportunity to test certain scenarios, but we shouldn't really be rushing into any decisions at this point until that legislation has passed and there's some certainty around that. So, and this distinction really is one of the key themes of today. Happy to act where the law is clear, but let's prepare diligently where the rules are still evolving. So we really want to have that as a key message for today. And Paul, this is where I'd really like your perspective. What are you seeing through the consultation process, and what are the key issues that are still being worked through?
Yeah, thanks, Dermot. Obviously, the formal Treasury consultation submission period regarding the changes to the minimum 30% tax on discretionary trust closed on the 31st of July 2026. So the measure is no longer actively open for submission, but it still remains as a proposal and are not yet law, as you've already rightly stated. So the government is now considering feedback on the design and the implementation detail before legislation is introduced. So there's going to be a lot of discussion happening over the next, I'd say, couple of years before this really comes into law, if it is as it is proposed in 1 July 28. The real planning implications will turn on the detail contained within legislation, obviously, and that includes which trusts and which types of income are actually excluded and included in this minimum 30% tax, how franking credits are going to be treated, which I'm sure a lot of those people listening today will be impacted by this, how the trustee level tax is collected, so the actual mechanism for collecting the tax, and there's been a whole range of discussion through various groups already about that process, and obviously how the rollover relief will operate in practice. So there's a period of potential rollover relief that may be come into play, and how that will impact those various decisions that are to be made. So also, too, just going with the CGT and the negative gearing changes, obviously, as you've said, there are already in law, but there continues to be further consultation about this design, its application, its implementation. For example, there's an open consultation period to the 21st of August this year, but we see that timeframe is obviously exceptionally limited in time. The government isn't giving a lot of time for this consultation and feedback, which we find quite disappointing and quite surprising. But well, actually, we probably shouldn't say it's surprising. It probably isn't, but given they're trying to rush it through, but well, they have rushed it through. But yeah, there's so many things to still unpack with those CGT reforms and negative gearing changes that are already in place. And there's changes happened as late as last week with regards to properties being transferred via divorce or via death in a joint tenants scenario. So there's things evolving every day with these changes, and I think they will continue to do so. So at this point, our job is to obviously identify the clients most exposed to the various changes, do some modelling and scenarios, and prepare for the restructuring window without making irreversible decisions before the legislation is actually settled down and actually in law.
Yeah, that's a
Um,
really
yeah.
important point, isn't it? Just to sort of press the pause button. There's a lot of information that we still don't know about all of this. And
Yeah.
obviously the government thankfully have given us a bit of time to sort of make these adjustments and restructuring and get our head around
Yeah.
it. So we're certainly
Yeah.
thinking about it, but there's no hard and fast rules that we can yet play with. So yeah, I think that's
Yeah.
a really important message, isn't it? So
Yeah.
with the rules now clearer, The next issue really is timing, particularly for those holding assets with large unrealized gains. So for long held assets, the planning question is not just how large is the gain, it's also when is that gain likely to be realized? Because for a lot of people with those larger assets, particularly properties, the intention is to sell at some point, diversify, and how that fits into the broader strategy we'll talk about. But Paul, from a tax perspective, how should clients think about that trade-off between crystallizing a gain under the current rules versus holding the asset throughout this new regime that we're talking about?
Yeah, and that's the million dollar question, isn't it? Just the timing of these actual transactions. If it was already a lot, you were likely to sell an asset in the medium term, perhaps to fund retirement or to reduce a concentrated holding of a specific asset class, or selling a business interest or repositioning your portfolio. The 1 July 27 day obviously becomes much more relevant, and we're having these conversations already with clients every day. Clients are already making decisions about whether they should sell now as opposed to waiting, modelling those calculations. There's broadly two parts, obviously. The first is whether it makes sense to crystallise some of those gains under the existing 50% discount regime. And some of that will be dictated by, again, how long you've actually held that asset prior to this 1 July 27 date. It may be a pre-85 asset. It may be, and that may have an impact if you do hold it past 1 July 27. So obviously pre-1985 being prior to when CGT came in, for those that are listening that don't know that. So that's obviously an important point. The second is to retain the asset and accept the future growth past that 1 July 27 timeline, and understanding they'll fall in that new indexation or inflation-based framework with a minimum 30% tax. So it's really just, again, modelling those scenarios, and how that feeds back into obviously financial planning, which is your realm, obviously, Dermot, and whether that asset is is part of that long-term strategy.
Yeah, yeah, and that will definitely give some further insights on that. But I think the key message here, from what I'm hearing there, is that this should never become a tax only or deadline driven decision. We still need to ask whether the asset is worth holding, what role it plays in the portfolio, and whether selling improves the client's overall position and what happens to the proceeds if we do sell. So it does actually require a lot of thought beyond just that high level decision. So, and I think the opportunity here is not necessarily to act quickly, it's to use this lead time that we've got to start to, as you say, model the options properly and make some really high quality informed decisions. So with that, timing is one part of the equation. The other is being able to evidence and measure that gain properly. And this has been under the spotlight in terms of valuing assets. Paul, can you take us through why valuation and record keeping now become so important for assets held across that transition date?
Absolutely. So this is probably the biggest area for me out of everything that I find hard how it's going to actually apply, just commercially and intangibly in the economy, given the quantity of valuations that would need to have to take place on 1 July 27. So the important part of the CGT changes is that you would need a valuation done on any type of asset as at the 1st of July 27 to have that clear cut-off point between the pre-tax regime, i.e. the 50% discount portion or regime where tax or gains made prior to that 1 July 27 are still under the old regime. And then from the point in time when the growth between 1 July 27 and when you sell that asset, that being under the new regime. So that valuation becomes critically important. We're obviously currently looking into the future. So modelling is based on assumptions of value at that future point in time. So we, to technically get a valuation now at 1 July 27, we need to wait. So it makes it exceptionally hard, obviously, to try and understand or model out those numbers. And it's all going to be based on assumptions at the moment. It'll be interesting to see whether the ATO accepts only sworn valuations. There's been some talk about, obviously, I heard yesterday that there's about 11,000 registered valuers in the country. So how they're going to be able to go out there and value all these properties by 1 July 27 is beyond me. But maybe Treasury has something that they understand that we don't. Or whether they may be more liberal and allow, say, a real estate agent to provide a letter of value, which I don't think they will allow. I think they want more of those concrete, hard valuations. Someone actually told me yesterday that the ATO is potentially looking at providing their own valuations to taxpayers for these properties. So I find that quite funny. I don't know how I'm a tax agent, but I don't know how far we trust the ATO to provide the best valuation in the best interest of our clients. So,
Mm,
given this valuation is a key in determining the overall tax payable under the old regime, i.e., the 50% discount regime prior to 1 July, and the portion past the 1 July where it's under the indexation and the minimum 30% portion of the gain. Everybody's talking at the moment, well, let's maximise these valuations at 1 July. Let's go out there and get those form valuations and pump them up as high as we can go.
mm,
Now, I mean, how well we can do that with properties and with the current market, as we've seen, come down and contract somewhat,
mm,
given these changes, is going to be interesting to see. So, this valuation concept is quite critical. Another thing they're actually talking about is whether, and this again, consultation, as we said, it is in law, but there's still a lot of consultation to be had, whether they may allow an apportionment basis of your capital gain calculation. So we don't want to get too technical today, but basically saying, here's your start point, this is what we bought it for, here's your end point, this is what you sold it for, and apportionment based on the timing pre 1 July 27 and post. Now, that has other complications about, timing of ups and downs in these valuation of all these asset prices, and a lot of it obviously has been around property, but we're talking about shares in listed companies, easily seeing what those
mm,
valuations will be in the market at 30 June, but could there be some manipulation in the pricing to in the market on that last day of the year to pump
mm,
prices up? We just don't know. So I also, obviously, having a number of business clients, a lot of people probably haven't thought as much about, okay, what about values in operating businesses? How are
mm,
they going to be valued at 30 June 27?
yeah.
I'm an accounting firm. How does my accounting firm get valued to determine what the shares are worth?
Mm,
Apt Wealth, how does Apt Wealth, shares get determined? And a construction company or whatever it might be. So a doctor's firm, a doctor's practice, sorry. So there'll be these valuations popping up everywhere, and the cost burden that's going to be imposed by these valuations is extraordinary. So
yeah.
there is still a lot of, I think, consultation to happen in the CGT space, particularly around these valuations. It's going to be such a critical point in time to help us determine and model these scenarios for our clients.
Yeah, so I think watch this space, but yeah, certainly the
Yeah,
cost of obtaining those valuations. I think those 11,000 valuers are going to be pretty busy in the forward period, aren't they?
yeah,
Um,
absolutely.
so the key takeaway here, obviously, is that particularly for long held assets, let's start organising the records now, not when a sale is already underway. You don't want to sort of be playing catch up if the ultimate intention is to be selling those assets, but we do have a bit of time up our sleeve to be able to start planning. And
Yeah,
beyond that, once the timing and valuation are understood, the decision needs to be tested against the client's full financial position, not simply that tax bill, which is the key focus of a lot of the planning at the moment. So, Paul, when you're assessing whether a client should hold or sell a long held asset, how do you weigh that tax outcome against other things like cash flow and debt and the opportunity cost of not doing anything?
yeah. So, I mean, holding an asset with a large unrealised gain may defer the tax, but it can also come with a cost. So, capital remains obviously tied up. The portfolio may become more concentrated in that asset class, and there may be better opportunities elsewhere, which is where obviously the financial planners come in.
Mm,
But clients therefore need to assess whether the assets expected after tax return still justifies that trade-off. Debt obviously creates another layer on top of that, where an asset is geared. CGT cannot be considered in isolation from interest costs, from debt servicing capacity, from loan terms, and the client's broader cash flow, reliance and resilience.
mm.
So this is where I see your accountant or your tax advisor working hand in hand with your financial planner or advisor to construct the tax, capital, cash flow, and opportunity cost trade-offs that this scenario has created.
Yeah, thanks, Paul. So the key
Mm.
takeaway there is that the decision whether to sell or to hold needs to consider whether retaining the asset still delivers the best overall outcome for the
Yeah,
family. Once we consider holistically the tax, the debt implications, liquidity concerns, the risk and return attributes of those assets in the broader portfolio, and what alternatives are available to reinvest those proceeds. So, um, beyond that, I think effective CGT planning also needs to carefully consider the client's broader investment strategy, and we did touch on that just before. But for instance, a concentrated position, it might be really tax efficient to hold, but inefficient from a risk and return perspective. So I think sometimes it is about biting the bullet and paying that tax for the benefit of being able to diversify more broadly. We need to weigh up that tax cost of selling for that benefit of diversification or lower volatility that you might be able to pursue when you come to reinvest the proceeds, and also the flexibility to meet future spending or retirement income needs. And we're seeing for a lot of these assets, the particularly illiquid, large property holdings, things like liquidity, price transparency, investing in more traditional asset classes that don't have these other concerns, I think is a good thing to really review at this point in time. The other thing is that asset location, so where you actually own the assets and what structure, is becoming increasingly important. It's always been important, but even more so now, because the same investment can produce very different tax outcomes depending on whether it is owned personally, through a trust, in a company, or within super. This is why, as a firm, we are increasingly looking across the whole family balance sheet and allocating assets between different structures based on tax, liquidity, risk and return, estate planning needs, rather than just simply replicating the same portfolio in every structure. So this could take the form of having a slightly higher proportion of growth assets, say equities, in superannuation, and a slightly higher proportion of defensive assets, so cash and fixed interest bonds in trusts and companies, so that we look at things holistically. But that tax mix tends to produce an overall better outcome in terms of how those portfolios deliver those returns. And finally, for those who expect to fund retirement or other major objectives from asset sales, the sequencing it matters even more so now. So the order in which assets are sold can affect the marginal tax rates that are paid, the use of capital losses that might be in existence, the timing of cash flows, and ultimately how long the capital is expected to last. So you really do need to step back and really diligently think through this sell versus hold decision. So that leads us on to trust, which is one of the major parts of reform that we're still working through the details of. And this is the structure through which many families build and protect their wealth, and the discretionary trust. So Paul, we know that discretionary trusts have traditionally delivered a range of benefits, and under the current proposals, how should family groups be rethinking the role of their trusts?
Definitely changed the outlook of us accountants, that's for sure, with the traditional default being family trusts, being somewhere within your structured tree. But that's obviously now under pressure. Discretionary trusts have obviously historically been used as they offered income splitting options, asset protection, which is one of the key ones I see as being the major change here, especially when we get to talking about the rollover opportunities. But so income splitting flexibility, asset protection, and estate planning, obviously with which is where obviously as financial planners and your lawyers come in, but in conjunction with your accountants. So under the new environment, the question is whether that flexibility still justifies the compliance, the administration, and the tax trade-offs that come with it. So the distribution strategy obviously needs to be reviewed, and obviously that gets reviewed every year if you've got a discretionary trust anyway, but it really has much more, focus now, given these proposed changes, I should say. So if trust income ultimately ends with lower cost beneficiaries, that minimum 30% tax on discretionary trust income could materially reduce the benefit of that existing distribution pattern. Especially where the trust has been used primarily as a tax allocation vehicle. So obviously we look at that every year and we say, okay, well, what position does certain individuals have within that family group to be able to distribute to them? Obviously, looking at this obviously has implications with regards to, or has in the past with Section 100A about streaming of that income to people and whether they're actually receiving those distributions. So this all comes into the same discussion, really. The other major change, obviously, with regards to this and this, general go-to of trust is how it impacts with corporate beneficiaries. And obviously, we've seen so far with what they've released to date that corporate beneficiaries may not be the go-to either now with these family trust structures, given the additional tax that seems to be going to be in play when distributions are passed on from a family trust to a corporate beneficiary or a bucket company, as they sometimes well known for. So, that tax looks like it can creep up to 60, 70% and even higher with more, I guess, detailed structures. So I don't think people like giving away 2/3 of their tax or more. I don't think people like giving away 1/3 of their tax, but given these change or the proposed changes, that doesn't look very favourable. So, I've probably got 80% of my clients that either having a business or a passive investor client that would have a family trust in their structure. So this planning process will now be even more critical than ever. And obviously to ascertain the best approach, what the best approach will be under these each of these specific scenarios moving forward.
Yeah, and just to sort of reiterate that corporate beneficiary point. So you're saying there, Paul, that there's effectively a double taxation when you're using companies to stream income from a family trust or discretionary trust.
Correct.
That
Yeah.
minimum 30%, unfortunately, the government are not giving companies the ability to use that 30% that's paid at the trust level to offset the tax that would ordinarily be paid at the corporate beneficiary or bucket company level, which is 30%. So effectively, there's two layers of 30% or 60%.
Yeah.
And that's not to mention the tax that you would have to pay to get the money out of that company from that point. So,
Correct.
yeah, it seems like that's been on their hit list, and they don't want people to use corporate beneficiaries moving forward. They've made that pretty clear.
It
So
has been.
the other aspect there, or the next step, is to ask that broader question of what role is the trust actually performing for the family? So trusts should not be judged on function beyond tax planning. The real measure of a trust is its purpose, not its precedent. So if a trust exists mainly for tax reasons, it deserves a fresh review at this point. But where it also provides or supports asset protection, intergenerational wealth transfer intentions that might be there, control and succession planning, those non-tax benefits, they need to be considered and weighed alongside the expected tax outcome as a result of these proposed changes. So we think that a review of this structure should start with some practical questions like what assets sit in the trust, what debt might be attached to those assets, who actually benefits economically from the trust, who controls the entity, and what is the effective tax rate today and how might that change over time? Because for some or a lot of people, there's going to be people paying 30% or more already in their trust structures and at the beneficiary level. And so these changes don't really affect them in that regard. It's just those that are trying to get the effective tax rate across their family group, beneath that 30%. It's going to be harder to do that moving forward. So, but we also need to ask whether the current ownership structure still aligns with the family's longer term objectives. So this might include things like retirement, their cash flow needs, estate planning, and the next generation's role in the family group. Because for some families, the real question is not whether to continue using a trust at all, it's whether the trust should continue to own certain assets. And I think that's where this rollover relief period that we'll talk about gives an opportunity to restructure that in an effective way. And it also opens up a conversation around alternative ownership structures. So including, does it make sense to start to own assets in your own names or in a company or in superannuation through larger superannuation contributions if that's available to you, or things like a fixed trust, which are exempt from some of these changes, or another restructuring pathway, and whether it's commercially, legally and strategically appropriate. We need to unpack all of that. And that really leads us to this 3-year rollover window. So, Paul, if a family does reach that conclusion that their discretionary trust is no longer the right long-term structure, what opportunity does this proposed rollover window create for them?
Yeah, so the rollover window obviously provides a planning runway rather than having to force families or groups into any sort of rush decision. So it really, I mean, if anything that's come out of this, that 3-year window has actually been quite a positive. Some groups are actually pushing for a 5-year window given the quantity of restructures that may have to occur. But again, this is not in law yet, so we'll see what the end result ends up being. Obviously, that 3-year window, there are some, I've already said that some have obviously pushed it for the 5-year window, but it also will allow family groups to move assets out of discretionary trust to alternative structures, such as a company or fixed trust, as you've already alluded to, without the restructure itself actually creating income tax consequences like CGT. So they are allowing for this rollover to occur without incurring capital gains tax on these changes to the movement of these assets. So obviously it doesn't mean the tax disappears. It just means that the rollover is intended to defer the immediate tax consequence of the transfer. But there obviously will be, tax to pay in the future on any sort of gain. So the destination structure must be right, not only at the time of the transfer, but also for your future income planning, growth, and eventual sale, and the tax consequences of that sale at the end of it. The option is obviously to use a window to make a considered approach for the family group. So, the assets in the trust, the debt and cash flow that is attributed to those assets, beneficiary entitlements, looking at bucket companies and their, as we said before, are they now worthless or are they still play a part in the planning process? Relating to unpaid present entitlement, succession planning, those objectives that, and the likely tax outcomes under each of those alternative structures. So there's a lot to unpack there. Every situation is going to be different. For some clients, retaining the trust may still be the right answer. As you said, there may be clients that have already got a higher tax rate than 30%. Ultimately, the income flows through to the individual, and therefore it's not going to make any change to their overall tax position. So in those situations, it may be right to retain that trust structure and retain those added benefits of asset protection. It's income splitting, like we talked about earlier. For others, the window obviously creates opportunities to maybe even simplify the group and move the assets to a structure that better aligns with the family's long-term objectives. So the key message obviously is to start the analysis early. So start now. Start chatting with your accountant, start chatting with your financial advisor, knowing in the back of your mind that obviously these aren't in law yet, but it's important to get ahead of it with the idea that these may come into law at obviously the time in the future at 1 July 28, which is when these trust laws come into play. Critical to look at it from a commercial sense, from an investment sense, from a tax sense, from an asset protection sense, from a succession planning sense, from a legal sense. It's just looking at it from every aspect and having those people around you that have those individual, specialties to help support the decision that may have to be made at some stage in the future.
Yeah, that's a really good point. Thanks, Paul. So Paul has now outlined the opportunity that rollover window might create. And the practical question now is, where should families begin? And this is where we want to get into some tangible strategies that you can apply when looking at your situation. I think the first step is to update the family balance sheet. So before considering a sale or a restructure or a transfer, we need a current and complete view of what is owned, who owns it, and what sits around that asset. And this is the foundation upon which we can help you model the impact of the new rules. We can compare alternative strategies, and then we can effectively map out the path forward. And the second step, which I've been harping on a lot in conversations with clients, is tune out the noise. Tax announcements can create a whole host of dramatic headlines, but headlines rarely capture the detail and the nuance that determines the outcome for each individual family. And that's what our job is to do that. And the right response, in my mind, is neither panic nor complacency. It's informed, measured planning where we understand the facts, we quantify the potential impact, and we act only where there is a clear strategic reason to do so. So, in terms of some more strategies, Paul, once a family has a clear picture of that current position in terms of the balance sheet in the context of the budget changes, how do they test whether their existing structures remain fit for purpose?
Yeah, good question. So obviously, as you said, once the balance sheet is current, you've got obviously everything mapped out about what your assets are, what your liabilities are, what your cash position is, looking at obviously what your retirement expectations are or your planning and succession is. Obviously, you would look at running like a stress test on those assets and what changes, additional tax may be payable if we make any of these changes, et cetera, et cetera. So every entity in the family group should be able to explain its role and what it adds in value to your family group. So that's probably the starting point. the question is not whether a trust or company or other structures worked historically. It is obviously now whether it remains efficient or remains commercially sound, I should say, and again, whether it's aligned with your objectives under the proposed rules. So a useful starting point is obviously to model the structure on the assumption that discretionary trust income is subject to 30% and 30% tax. And would the existing distribution strategy that you currently have in play still deliver the appropriate outcome, whether that is a financial outcome or a tax outcome? So looking at both those combined. Also looking at obviously the asset protection outcomes, the succession planning outcomes, looking at all those different areas holistically and running that test to see if it actually still works for you or not. And if the answer is no, then that doesn't necessarily you need to take immediate action now. It just means that it gives you a clear signal that you need to explore whether the structure could be simplified or changed and whether assets should be repositioned. So, and that's where obviously this rollover relief period will come into play. The stress test should extend beyond just tax. Very odd to say from an accountant, but it actually is working hand in hand with your financial planner. And that's what we do every day, working with financial planners, working with your legal advisors, working with your succession planning and your estate planning advisors, and the practical ability to fund, even liabilities across those groups if there are any of those changes. As we talked about before, corporate beneficiaries or bucket companies also need a fresh review in this, proposed new landscape. Historically, they've often been used to retain income at a corporate tax rate, smooth taxable income across years, and defer the timing of those distributions to family members, generally once they've retired and no longer earning, work-related income. So the proposed rules may change the economics of that approach. The review on top of that should also look at the tax rate beyond the tax rate. It needs to examine, unpaid present entitlements, loan agreements, loan accounts, Division 7A exposure, the cash actually available in each entity of the group, and its capacity to meet those tax obligations as they arise. So obviously, delving into more technical tax areas there. Some people may have come across them and some may not, but these changes may actually create some of these issues, and we want to make sure that we're not accentuating any issues. We take a holistic approach to that review or that stress test that we've sort of coined it. It's obviously a holistic review. For some families, as I said, the existing arrangement will still remain appropriate. For others, the review will reveal that the tax deferral benefit may no longer be sufficient to justify the complexity and the cost and the cost and administration behind having those structures. So just ensure we have every entity has a clear purpose, every entity's balance sheet is understood, and the family group remains robust under both today's rules and the rules that are proposed to come ahead.
Yeah, thanks, Paul. Some good points there. So, and a question I've been getting a lot lately is, should I sell? Seems to be front of mind for a lot of people. And I find the best way to answer that is by stepping back and unpacking what job is this asset doing for you, and just coming back to risk and return, as a lot of good financial advisors do. But the flow-on questions from this high-level question might include, is the asset providing reliable income? Does it give you liquidity? Does it give you diversification? Is it intended to deliver long-term capital growth that's acceptable? Does it provide lifestyle value or legacy for the next generation, or is it simply being held because it's always been held? And another useful question that flows on from that was, would you buy this asset today if you didn't already own it? Particularly for a lot of properties, there's a lot of people lament buying some properties, particularly older properties that have some maintenance issues. But if the answer is no, then this provides, I think, a strong prompt to reassess that investment case. And from there, I focus on three key things: the quality of the asset, the degree of concentration that represents in the broader family balance sheet, and how it fits within the broader financial plan. Where are we headed? So an asset might be high quality in isolation, but still represent too much of the family's wealth. It might generate insufficient income for the risk that's taken relative to alternatives, or it could create a liquidity problem when future spending needs arise. And a sale decision is not complete until we understand what happens next. I think this is really important in terms of what opportunities you have once the sale proceeds are received. What do you do with them? And that needs to be unpacked and thought through before the sale event takes place. And this means having answers to questions such as, where will the proceeds go? Who will own it? What structures are available to us? What happens to the portfolio's risk profile and liquidity position? And can we still achieve the goals that that asset that we're selling was originally helping to fund? We need to understand the answers to those questions before we head down that path of do I sell? So I think in that regard, there as well, we've got some other strategies here that these changes also highlight the need for property investors to now more clearly distinguish between existing holdings, new builds, and future established property purchases, because the tax outcome may be very different depending on when the asset was acquired and the nature of the property. So that means we can't rely on a single property investment playbook. Each asset needs to be assessed on its own merits. So that comes down to what is its expected capital growth? What is its rental income? What are the financing costs? What's the liquidity profile? What are the concentration risk in the broader balance sheet? And what's the role in the portfolio? How is it serving the family's needs? And another clear priority coming out of all of this, and you touched on this before with the valuation side of things, Paul, but we've got to have clear supporting evidence for things like acquisition dates, purchase costs, improvements that might be being put into properties through time. What were the selling costs, depreciation history, ownership changes throughout the life of the asset, and any other item that might contribute to the cost base. So this is really important, where future gains may now need to be separated between the period up until 1 July 2027 and then from 1 July 2027 moving forward. So, because without clear records, it becomes harder to substantiate that position and model the alternatives accurately and then make confident, informed decisions when that sale or restructure is being considered. So I think they're just really key strategies for us to think about and make sure we've got those clear records on file. And rounding this out, beyond tax, these strategies we've discussed are really important, but they're only part of the picture. The larger opportunity, as I see it, is to use this moment to revisit the family's overall wealth strategy. Because for many families, this creates a timely reason to visit the role of trusts, the succession plan, what are the current ownership arrangements, and what's the intended path of the wealth to the next generation. It also might prompt a conversation about whether some intergenerational wealth transfer intentions could be brought forward. So this could be in the form of super contributions for adult children, support for housing, support for education, helping kids with business ventures or philanthropic pursuits, for instance. This can provide the next generation with time, the power of the compounding effect, and greater financial security, while allowing parents or their grandparents to ultimately see the benefit of that support during their lifetime, which for a lot of families is a really important consideration. And now, of course, this needs to be done carefully. The family should remain clear on its own retirement needs, asset protection requirements, and things like, to ensure that the transfer aligns with their values, their capabilities, and their longer term intentions. So that just all needs to be thought through if we're to head down that path. And in that regard, one of the key messages from today that we've shared a number of times is that these decisions should not be made in isolation. So whether it's tax, investment strategy, cash flow, ownership structures, and succession planning, they are all inextricably linked. And it's our role as advisors to bring those pieces together, helping clients make clearer, more informed decisions that ultimately gives them the best chance of achieving what's most important to them. That's what it's all about for us. So if today has prompted questions about your own circumstances, please feel free to reach out to your advisor to begin that conversation. It's really important. And with that, we'll now take a few questions from the audience, and got one from Barry here, that after 1 July 2027, will the minimum 30% on capital gains only apply to index gains from 1 July 2027, or will it include the gain calculated with a 50% discount pre-July 2027? And Paul, I think this is obviously where there's that segmentation approach. So the
Correct,
gain
yeah.
up until 1 July 2027 will be under the old regime, and that will be subject to the 50% discount. So whatever gain that produces will obviously be accessible. And then
That's
it's
correct.
only from 1 July 2027, the indexed gain from that point will be subject to that 30%. And I think this is an
Yeah.
important point, is we're seeing central banks got a meeting later today, which will be very interesting to see what they come up with. But we might be in an era where we do see higher rates of inflation and therefore indexation than perhaps what we've come to know in the post-global
Correct.
financial crisis era. So
Mhm.
that might provide maybe not as bad an outcome as if indexation was, sub 2% like we saw for 15 years post-global financial crisis. So
Yeah.
hopefully that answers your question, Barry. There will be a segmentation approach, which is why that valuation as at 30 June is going to be pretty critical. And if we can get a nice healthy valuation as at 30 June, I think that'll be pretty favorable for the old tax outcome there if you end up selling. So that was one of those key questions. And then Paul, another one for you is that what does the proposed 3-year rollover window potentially allow a family to do? Like, what are the restructuring options as we know them at the moment, knowing that this is in a state of flux?
Yeah, so obviously that gives you the opportunity, obviously, to restructure any of those assets out of a discretionary trust into other fixed structures without incurring any capital gains tax in that movement or from the discretionary trust to another structure. And that's what usually in that sort of framework, if you were restructuring, there may be some sort of capital gain implication in moving an asset, whether it's property, whether it's shares, whether it's managed funds, whatever it might be. So again, these changes aren't in law yet. So it's important to just continue, as we said earlier, model and ascertain the possibilities, and then wait until the law is passed before we action anything. If actioning any changes is in fact required for your specific scenario.
Yeah, good point.
Yeah.
And another one that I'll take is which advisors should be involved in all this process. And you mentioned there, Paul, there's obviously a number of different specialists. I like to say to clients that the role of the advisor, we're kind of like the conductor of the orchestra, the different specialists that surround the client. And so that project management piece is really important. So I think the best starting point is a coordinated conversation led by the advisor, or if you don't currently have an advisor, obviously the likes of Paul and your accountant are a good person to lead that conversation. And then we can wheel in, whether it be the tax specialists, the lawyers, to make sure that those other separate projects are attended to, whether that's restructuring and setting up other entities like a company, different trust structures. How that affects the estate planning documents is going to be really important as well. So I think getting that coordinated approach that we lead, that's our bread and butter, I think. So and Paul, another one for you is it better to distribute income personally now rather than to retain it in a company? And obviously that speaks to some of the corporate beneficiary rule changes there that are taking effect, and how to go about thinking about that question there, Paul.
Yeah, it's a good question. I think I've had that question quite a bit over the last few weeks.
Mm,
Again, it's one where the specific client scenario needs to be considered. So the answer may be driven by a life cycle, i.e., are individuals retired, and can the income be distributed to the individual with a minimum 30% tax rate applied? Is it driven by asset protection, with individuals not wanting the funds in their personal name? Example, if you're a business owner. It's driven by the two things: the different types of income that may be coming out of a family trust, i.e., is it franked income, and the additional tax that will be apply, and the non-refundable tax credits that do not these refundable tax credits that are non-refundable to via a company, and not
mm.
flowing through to a company or a corporate beneficiary. So it's not a one answer fits all. Unfortunately, it's obviously a very broad question, but it just emphasises the importance of reviewing your specific scenario and how it applies to you and your family group.
Yeah, that's right. We're just going to have to model
Yeah,
each client, aren't
yeah,
we, to get the best outcome for every family.
yeah, yeah.
So, Paul, with that, thank you for sharing your insights, and thank you to all who joined us today. We hope that you enjoyed the webinar. And as I said before, if you have any questions, please contact us or your advisor to discuss further. Until then, bye for now.